It's a common misconception, a dangerous myth that permeates every corner of the financial world, from the frantic trading floors of Wall Street to the quiet conversations over coffee about retirement accounts. The myth is that the secret to getting rich, the key to successful investing, is being right. It's the idea that a great investor is someone who can predict the future, a crystal ball gazer who knows which stocks will go up and which will go down. They are judged on their batting average, the percentage of times they call the market correctly. And so, the average person chases this illusion. They listen to endless news cycles. They study complex charts with arcane indicators. They subscribe to newsletters that promise the next hot tip, all in a desperate attempt to be right more often than they are wrong. They believe that if they can just get their win rate up from 50% to 60% or even 70%, they will unlock the gates to financial freedom. But what if this entire premise is a lie? What if the single most important secret to building generational wealth has almost nothing to do with how often you are right? Warren Buffett, a man who has compounded wealth on a scale that defies comprehension, doesn't play this game. He operates on a different plane, using a mental framework that is closer to that of a professional poker player than a stock market analyst. He understands a profound truth that the 99% of investors miss. In the game of long-term wealth building, the frequency of your wins is a vanity metric. What truly matters, the only thing that moves the needle from mediocrity to mastery, is the magnitude of your wins when you are right, weighed against the magnitude of your losses when you are wrong. It is not about the batting average. It is about the slugging percentage. You can strike out 9 times in a row, but if your one hit is a grand slam that clears the bases and wins the game, no one remembers the strikeouts. This is the heart of probabilistic thinking. It is a radical shift in perspective that transforms investing from a guessing game into a calculated science of risk and reward. It is about understanding that you don't need to predict the future. You only need to find situations where the odds of success, combined with the potential payout, are overwhelmingly skewed in your favor. And when you find such a situation, you don't just take a small position, you bet big. You concentrate your capital in a way that would make a conventional financial advisor break out in a cold sweat. This is the core of Buffett's genius, the engine of his capital allocation machine. It's not a stock-picking secret. It is a betting secret. And today, we are going to deconstruct this secret, piece by piece, building the mental model that will allow you to stop trying to be right and start focusing on making sure that when you are right, you are very, very right. This is the foundation of advanced investing, the CEO mindset that separates the amateur from the professional, and it is the key to truly beating the market. Our journey begins by dismantling one of the most sacred cows in personal finance, the gospel of diversification. The old adage, "Don't put all your eggs in one basket," is preached as the cornerstone of prudent portfolio management. Financial advisors build careers on it, creating complex portfolios with dozens, sometimes hundreds, of different stocks, bonds, and funds. The logic seems sound on the surface. If one investment goes bad, the others will cushion the blow. It's a strategy built on fear, a defense mechanism designed to protect against the worst-case scenario. But Buffett and his partner Charlie Munger see it differently. Munger once quipped that the whole idea of diversification is for the know-nothing investor. Buffett is even more direct. He has called widespread diversification protection against ignorance. He argues that it makes very little sense for someone who knows what they're doing. If you have thoroughly researched a business and have extremely high conviction that it is a wonderful company available at an attractive price, why would you then take a significant portion of your capital and invest it in your 20th or 50th best idea? It's an act of financial self-sabotage. The truth is, truly exceptional, once-in-a-generation investment opportunities are exceedingly rare. They do not come along every day or even every year. When one does appear, the logical course of action is not to take a small, timid position. It is to back up the truck. This philosophy of concentrated investing, of betting heavily when the odds are overwhelmingly in your favor, is the first pillar of Buffett's probabilistic betting system. It is the practical application of high conviction. The most visceral and career-defining example of this principle in action took place in the winter of 1963. It was a moment that would test the nerve of any investor and solidify the legend of a young Warren Buffett. The event became known as the Salad Oil Scandal. A company in New Jersey called the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis, had perpetrated one of the most audacious frauds in financial history. DeAngelis had discovered a loophole in the warehousing system. He would take out massive loans using his inventory of salad oil as collateral. The lenders, including major Wall Street banks and financial institutions, would send inspectors to his massive storage tanks to verify the collateral. The tanks were, indeed, full of salad oil. What they didn't know was that DeAngelis had installed a secret system of pipes. Most of the tanks were filled with seawater, with only a thin layer of valuable salad oil floating on top. When inspectors dipped their measuring sticks in, they hit oil, and the paperwork was approved. DeAngelis had effectively borrowed against billions of pounds of phantom salad oil. His company was a house of cards built on salt water. In November of 1963, the music stopped. The fraud was exposed, and Allied Crude Vegetable Oil declared bankruptcy. The fallout was immediate and catastrophic. The company owed an estimated $175 million to its creditors, an astronomical sum at the time. One of the biggest victims of this fraud was American Express. Amex ran a warehousing subsidiary that had issued receipts for DeAngelis's non-existent oil, effectively guaranteeing its existence. When the fraud was revealed, American Express's stock was annihilated. Panic gripped Wall Street. Investors, analysts, and even company insiders feared that Amex would be on the hook for the entire $175 million, a liability that could potentially bankrupt the company. The stock price plummeted by nearly 50%, falling from over $60 a share to just $35. The herd was running for the exits, screaming that American Express was doomed. This is where Warren Buffett, then a 33-year-old money manager running a small private partnership in Omaha, saw not a crisis, but the opportunity of a lifetime. Instead of panicking, Buffett engaged in a classic act of what he called investment sleuthing. He didn't rely on newspaper headlines or the panic chatter of Wall Street analysts. He went out to do his own primary research, a hallmark of his investment strategy. He started visiting restaurants and banks in Omaha. He would talk to cashiers, merchants, and loan officers. He wasn't asking about the salad oil scandal. He was asking about their customers' behavior. Were people still using American Express credit cards? Were they still cashing American Express travelers' checks? The answer he got, over and over, was a resounding yes. He saw that the company's core businesses, its payment systems, and travelers' checks were completely unaffected by the scandal in the warehousing division. The brand, the powerful moat around its business, was intact. He realized that Wall Street, in its panic, was confusing a single, massive, but survivable problem in one subsidiary with a fatal flaw in the entire enterprise. He calculated that even in the absolute worst-case scenario, if Amex had to pay every single dollar of the fraudulent claims, the loss would be significant, but it would not destroy the fundamental earning power of its core franchises. The market was pricing the company for bankruptcy, while Buffett's analysis showed it was a world-class business hitting a serious but temporary pothole. Here is where the principle of concentration comes into play. A conventional investor, even one who saw the same opportunity, might have taken a small, prudent position, maybe 5% of their portfolio. They would have diversified their bet, hedging against the possibility they were wrong. Buffett did the exact opposite. He concluded this was not just a good idea. It was a screaming, no-brainer, bet-the-farm opportunity. It was the fat pitch he was always waiting for. So he took 40% of his entire partnership's capital, a staggering concentration of risk by any conventional measure, and plowed it into American Express stock. It was the single largest investment he had ever made. He was betting his career, his reputation, and his partners' money on this single high-conviction idea. The outcome, of course, is history. Over the next few years, American Express settled the salad oil claims for a fraction of what the market feared. The core business continued to grow exponentially. The stock price roared back. Buffett's partnership made a fortune. That single, concentrated bet was a pivotal moment that launched him into the financial stratosphere. It was a masterclass in ignoring the herd, doing your own work, and when you find an opportunity where the odds are overwhelmingly in your favor, betting with extreme, audacious concentration. It laid the foundation for a lifetime of portfolio management built not on timid diversification, but on decisive, concentrated capital allocation. The decision to concentrate capital so heavily, to take 40% of a fund and place it on a single stock, runs contrary to every instinct of the average person. This isn't just a matter of financial training, it's a battle against deep-seated psychological wiring. The behavior Buffett demonstrated in the salad oil scandal is a direct confrontation with a powerful cognitive bias known as ambiguity aversion, often coupled with what we can call diversification bias. Ambiguity aversion, first identified by Daniel Ellsberg in 1961, describes our tendency to prefer known risks over unknown risks. We'd rather choose a bet where we know the odds, say a 50% chance of winning $100, than a bet where the odds are uncertain, even if the uncertain bet might be statistically better. In the case of American Express, the situation was rife with ambiguity. No one knew the exact size of the liabilities. No one knew how the courts would rule. No one knew if there would be further undiscovered fraud. This ambiguity creates a profound sense of psychological discomfort. The brain craves certainty, and when faced with a fog of unknowns, its default response is to flee to safety. The safe choice for investors in 1963 was to sell Amex stock, or to avoid it entirely, and put their money into something more predictable, even if the potential returns were far lower. This aversion to ambiguity directly fuels the diversification bias. This isn't a formally recognized cognitive bias, but it's a behavioral pattern that plagues amateur and professional investors alike. It's the act of diversifying not for strategic reasons, but as a psychological coping mechanism. An investor might have 10 ideas. They've researched all 10, but their research on idea number 1 is deep, rigorous, and has produced a very high level of conviction. Their research on ideas number 2 through number 10 is progressively more superficial. A rational capital allocator would put the vast majority of their capital into idea number 1. But the diversifier doesn't. They put 10% into each. Why? Because concentrating on idea number 1 feels risky. It puts their judgment squarely on the line. If idea number 1 fails, the failure is entirely their own. It's a single, glaring mistake. Spreading the money across 10 ideas diffuses this psychological burden. If a few of them fail, it's easier to rationalize. You win some, you lose some, they'll say. It's a hedge not against financial loss, but against the emotional pain of regret. This is why so many people end up owning a collection of 50 or 100 different stocks, a portfolio that is essentially a high-fee, self-managed index fund. They are collectors of financial instruments, not concentrated business owners. They are buying psychological comfort at the expense of financial returns. Buffett's brain is wired differently. He actively seeks out ambiguity and panic in the market because he knows it is the source of mispricing. He then uses his own intense research to cut through the fog of ambiguity, transforming an unknown risk into a known and highly favorable one. Once he has done this work, he feels no psychological need to hedge. To him, buying his 20th best idea, instead of adding more to his single best idea, would be the definition of insanity. He has overcome the primal fear of ambiguity and embraced the logic of concentration, a key component of a true CEO mindset in capital allocation. So how can we, as individuals striving for better financial outcomes, translate this into a practical, usable system? How do we build the discipline of concentrated investing into our own process? The blueprint for this is a powerful mental model that Buffett himself has shared, the 20-slot punch card. Imagine that at the beginning of your investing life, you are handed a punch card with only 20 slots on it. These 20 punches represent the total number of investments you are allowed to make in your entire lifetime. Once you've made 20, you're done. You cannot make another. This simple thought experiment is a profound forcing function. It immediately and radically changes your decision-making framework. It shifts your mindset from that of a speculator, chasing fleeting ideas and market chatter, to that of a deliberate, long-term business owner. Let's walk through the step-by-step application of this model. Step 1 is to internalize the scarcity. You must truly believe that you only have 20 slots. This isn't just a fun game, it's a foundational rule for your entire investment strategy. Every time you are tempted by a stock tip, a news headline, or a surge of FOMO, you must ask yourself the critical question: is this idea so good, so thoroughly researched, and so overwhelmingly probable to succeed that I am willing to use one of my 20 precious, irreplaceable lifetime slots on it? For the vast majority of opportunities that cross your desk, the answer will be a swift and resounding no. This immediately filters out 99% of the noise and distractions that cause most investors to fail. Step 2 is to redefine what constitutes an idea. Under the 20-slot rule, buying a stock is not a casual act. It is a major commitment. Therefore, an idea cannot be just a ticker symbol. It must be a fully developed investment thesis, written down. This thesis should include a detailed explanation of the business, its competitive advantages, the quality of its management, the long-term prospects of its industry, and, most importantly, a conservative valuation of what the business is worth. You should be able to explain, simply and clearly, why this business is a wonderful company and why the current market price offers a significant margin of safety. If you cannot articulate this in writing, you do not have a punch-worthy idea. This forces the kind of deep research that Buffett performed during the salad oil scandal. Step 3 is to let the ideas compete. You won't fill your punch card overnight. You may go months, or even a year or more, without finding an idea that is worthy of a punch. During this time, you will be researching and building a watch list of potential candidates. These are your B-plus ideas. You will track them, study them, but you will not act. You are waiting patiently for the A-plus opportunity, the fat pitch. When an event occurs, a market panic, an industry downturn, a temporary scandal that takes one of your high-quality watch list companies and offers it at a ridiculously cheap price, that is when you step up to the plate. That is when you use a punch. Step 4, and this is the crucial link to concentration, is to make each punch count. Because you have so few slots, it makes no sense to invest a tiny fraction of your portfolio. Each punch should represent a significant allocation of your capital. A 5% position should be your absolute minimum for a new punch. A 10, 15, or even 20% position for an idea with extreme conviction should be the norm. This framework forces you to align your capital with your conviction. You are not spreading your bets thinly. You are making large, calculated wagers on your very best ideas. The 20-slot punch card is more than just a mental model. It is a complete behavioral modification system for wealth building. It enforces patience, encourages deep research, and programmatically leads to a concentrated portfolio built on high conviction, mirroring the very strategy that made Buffett a billionaire. To fully appreciate the power of Buffett's concentrated approach, we must shine a harsh light on its antithesis, the path walked by the 99% of investors. This is the path of the financial collector, a behavior driven by a cocktail of fear, greed, and a fundamental misunderstanding of how wealth is truly built. The collector's portfolio is not the result of a coherent investment strategy. It's an archaeological dig site of past emotions and abandoned ideas. It begins innocently enough. They buy a few shares of a well-known tech company because they like its products. Then, a friend at a barbecue gives them a hot tip on a small biotech firm, so they buy a little of that, not wanting to miss out. They read an article about the future of cryptocurrency and feel a surge of FOMO, so they allocate a small percentage to that. A talking head on a financial news channel pounds the table for an emerging market ETF, and it sounds compelling, so they add a slice of that to the pie. Over the years, this process repeats itself. The portfolio grows not in value, but in complexity and clutter. It becomes a mishmash of dozens of holdings, each one representing a tiny fraction of the whole. The investor can't tell you the detailed investment thesis for most of them. They don't know the valuation, the competitive landscape, or the quality of the management. They are simply collecting ticker symbols like stamps or baseball cards. This approach is a guaranteed path to mediocrity, and often to significant underperformance. Firstly, it creates a closet index fund. With so many holdings, the portfolio's performance will inevitably mirror that of the broader market, minus one crucial thing: fees. Every transaction costs money. If they are using a financial advisor, that advisor is charging a percentage of the total assets. The result is market-like returns with above-market costs, a mathematical recipe for lagging the market over time. Secondly, and more insidiously, this collector's mentality completely neuters the impact of their best ideas. Let's say, through sheer luck or a moment of genuine insight, one of their 50 holdings turns out to be a massive winner, a 10-bagger that increases in value by 1,000%. It's the kind of home run that can create real wealth, but in their portfolio, the stock was only a 2% position. So, a 1,000% gain on a 2% position translates to only a 20% gain for the overall portfolio. A life-changing investment has been diluted into near irrelevance by the 49 other mediocre ideas surrounding it. The psychological driver here is the fear of being wrong. By spreading their capital so thinly, the collector ensures that no single mistake can hurt them too badly. But in doing so, they also guarantee that no single success can help them significantly. They have protected themselves from ruin, but they have also protected themselves from extraordinary wealth. Buffett's approach is the polar opposite. By making large, concentrated bets, he accepts the short-term psychological pain of being wrong, knowing that the long-term financial payoff of being massively right on just a few key decisions will ultimately determine his success. The collector is playing not to lose. Buffett is playing to win. The financial consequences of this philosophical divide are not subtle, they are staggering. Let's quantify the direct impact of concentration versus diversification on a portfolio's growth trajectory. Imagine two investors, Investor A, the collector, and Investor B, the concentrator. Both start with a portfolio of $100,000. Investor A, following the path of the 99%, diversifies across 50 different stocks, putting $2,000 into each. Investor B, using the 20-slot punch card mental model, waits patiently and identifies one single high-conviction opportunity, an American Express salad oil scandal moment. They invest $50,000 or 50% of their portfolio into this single idea and keep the other 50% in cash, waiting for the next fat pitch. Now let's project forward 5 years. For Investor A, the collector, their 50-stock portfolio performs roughly in line with the market. Some stocks go up, some go down. Let's assume a generous 10% average annual return, which is slightly above the historical market average. After 5 years, their $100,000 portfolio, compounding at 10% per year, will be worth approximately $161,000. A respectable, but not life-changing result. Now consider Investor B, the concentrator. Their $50,000 in cash earns next to nothing, but their single high-conviction stock, the one they researched relentlessly and bet on heavily, turns out to be a huge success. The initial crisis that created the opportunity subsides, and the company's true value is recognized by the market. Let's conservatively say the stock triples in value over the 5-year period, a 200% total return, which is entirely plausible for a great business bought at a panic-induced price. Their $50,000 investment is now worth $150,000. When you add that to their $50,000 in cash, their total portfolio is now worth $200,000. That's nearly $40,000 more than the diversified investor, a 24% outperformance, and this was achieved with just one good decision. Now, let's extrapolate. What happens if investor B finds just one more such opportunity in the next 5 years? The numbers begin to diverge exponentially. The power of a concentrated portfolio is that it allows your best ideas to have a meaningful impact on your net worth. It transforms the arithmetic of wealth building. Instead of relying on the slow, steady, and often diluted returns of a broad market index, you are leveraging deep research and high conviction to generate massive asymmetric returns on a handful of key decisions. On a company's balance sheet, this is the equivalent of a business focusing its capital expenditures on its most profitable division, instead of spreading it thinly across all divisions, including the underperforming ones. It is a ruthless application of capital allocation logic. The goal is not to have a portfolio where everything goes up a little bit. The goal is to have a portfolio where one or two positions go up so much that the performance of everything else becomes a rounding error. This is how real generational wealth is built. It is not through timid diversification, but through the courage of high-conviction, concentrated investing. The second pillar of Buffett's betting system drills deeper into the anatomy of a great investment. It's not enough to simply bet big. You must bet big on the right kinds of opportunities. The most successful professional gamblers are not just looking for bets they are likely to win. They are looking for bets where the payout structure is heavily skewed in their favor. This is the concept of an asymmetric bet. The simplest way to frame it is with the phrase Mohnish Pabrai, a disciple of Buffett, famously coined, "Heads I win, tails I don't lose much." This principle is the very heart of risk management in the Buffett paradigm. It means that you exclusively hunt for opportunities where the potential upside is many multiples of the potential downside. If an investment works out, you stand to make 5, 10, or even 20 times your money. If it fails, you might lose 10, 20, or perhaps 50% of your capital, but you avoid the catastrophic risk of a total loss. This focus on downside protection is counterintuitive. Most amateur investors are drawn to stories of explosive upside. They chase momentum, they buy story stocks, they dream of hitting the next 100-bagger. Buffett, in contrast, is pathologically obsessed with avoiding permanent loss of capital. His first rule of investing is never lose money, and the second rule is never forget rule number 1. The asymmetric bet is the mechanism by which he lives this rule while still generating extraordinary returns. He understood, long before it was popularized by behavioral economics, that the mathematics of compounding are brutal. A 50% loss requires a 100% gain just to get back to even. By focusing on opportunities where the tails scenario is a small, manageable loss, he preserves his capital base, allowing the magic of compounding to work its wonders on the heads scenarios, where the wins are massive and open-ended. A perfect illustration of this principle is Buffett's 1972 acquisition of See's Candies. At the time, Berkshire Hathaway was still primarily a struggling textile business. Buffett was using the cash flow from this dying business to buy into other, better ones. He and Charlie Munger were approached with the opportunity to buy See's Candies, a beloved, family-owned chocolate company based in California. The asking price was $30 million. Buffett's initial analysis, based on the quantitative metrics he had used for his entire career up to that point, told him the price was too high. See's had tangible assets, factories, inventory, real estate, of only about $8 million. The asking price included a $22 million premium for goodwill, an intangible concept representing the company's brand, reputation, and customer loyalty. Buffett, the classic value investor trained by Benjamin Graham, was used to buying cigar butts, mediocre companies at dirt-cheap prices based on their liquidation value. Paying a huge premium for an intangible asset like a brand name was completely alien to him. He was ready to walk away. This is where Charlie Munger played a pivotal role. Munger convinced Buffett to look beyond the simple numbers on the balance sheet and to appreciate the economics of a truly wonderful business. See's Candies was not just a collection of assets, it was a powerful franchise that lived in the minds of its customers. For generations, people in California had given See's chocolates as gifts for birthdays, anniversaries, and holidays. The brand was synonymous with quality and nostalgia. This created two incredible economic characteristics. First, it gave See's pricing power. Because customers were loyal and trusted the brand, the company could raise its prices year after year to offset inflation, without any fear of losing business. Customers weren't just buying chocolate, they were buying a feeling, and they were willing to pay a small premium for it. Second, the business required very little new capital to grow. It wasn't a capital-intensive business like a steel mill or an airline that needed constant, massive investments in new equipment. It was a simple business that threw off huge amounts of cash every year. Buffett and Munger began to see the asymmetric nature of the bet. Let's analyze the tails scenario. What was the downside? Could See's Candies go bankrupt? It was almost inconceivable. The company had a loyal customer base, a strong brand, and no debt. The worst-case scenario was that its growth might stagnate, or its profitability might decline slightly. They might overpay and end up with a business that only generated modest returns. The risk of a permanent, catastrophic loss of capital was virtually zero. Now let's look at the heads scenario. What was the upside? They were buying a business that was a cash-generating machine. The profits it produced each year could be taken out of the business and reinvested by Buffett into other opportunities. Furthermore, the brand had the potential to continue growing, and the pricing power meant that profits were likely to increase steadily over time. The upside was not just a one-time gain, it was acquiring a perpetual cash cow that would fund Berkshire's growth for decades to come. Ultimately, they paid $25 million for the company. Buffett would later call this purchase a turning point in his career. It taught him that it's quote, to buy a wonderful company at a fair price than a fair company at a wonderful price. See's Candies has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all of which Buffett has been able to reinvest elsewhere. That initial $25 million investment has returned more than 80 times its cost, without even counting the massive returns generated by reinvesting its profits. It was the perfect asymmetric bet. The downside was capped and minimal. The upside was enormous, durable, and compounding. It was a clear demonstration of heads I win, tails I don't lose much, a foundational principle for any advanced investing strategy. The human brain is spectacularly ill-equipped to deal with asymmetric opportunities. Our evolutionary wiring, developed over millennia of survival in a dangerous world, makes us hypersensitive to potential losses. This is the psychological principle known as loss aversion, a cornerstone of the Nobel Prize-winning work of psychologists Daniel Kahneman and Amos Tversky. Their research demonstrated, through a series of clever experiments, that the psychological pain of losing a certain amount of money is roughly twice as powerful as the pleasure of gaining the exact same amount. If you find a $100 bill on the street, you feel good. If you lose a $100 bill from your wallet, you feel absolutely terrible. The emotional impact is not symmetrical. This deep-seated bias has profound implications for an investor's decision-making. Loss aversion causes us to systematically underweight opportunities with massive potential upside, if there is even a small, perceptible risk of loss. Our brain's internal risk management system screams danger at the prospect of the loss, drowning out the rational calculation of the potential gain. Imagine you are offered a bet. A coin will be flipped. If it's tails, you lose $100. If it's heads, you win $200. From a purely mathematical, probabilistic thinking perspective, this is a fantastic bet. The expected value is positive $50. A rational person should take this bet every single time it's offered, yet in experiments, many people refuse it. The anticipated pain of losing the $100 looms larger in their mind than the potential pleasure of winning $200. They are letting a primal emotional response override a logical financial calculation. This is precisely the psychological barrier that Buffett overcomes. His obsession with tails I don't lose much is a system designed to short-circuit the debilitating effects of loss aversion. By focusing first and foremost on the downside, he is calming the primitive, fearful part of his brain. He is answering its primary question: what is the worst that can happen, and can we survive it? Only after he has satisfied himself that the risk of permanent capital loss is minimal does he allow his analytical mind to focus on the magnitude of the potential upside. The average investor does the exact opposite. They fall in love with the head's story first. They get excited about a new technology, a visionary CEO, or a stock that's going up. They construct a narrative of all the wonderful things that could happen. The potential downside is an afterthought, an uncomfortable detail to be brushed aside. This makes them extremely vulnerable to investments with a terrible asymmetric profile, a small, capped upside and a catastrophic downside, like speculating on a struggling company that might be a buyout target. The heads scenario is maybe a 30% pop in the stock price. The tails scenario is bankruptcy and a 100% loss. Loss aversion, when combined with a narrative-driven approach, leads to disastrous capital allocation. Buffett's genius is in reversing the sequence. He masters the risk first. By ensuring he can't be hurt badly on the downside, he frees himself to fully capitalize on the upside, a key discipline in professional portfolio management. How can we operationalize this obsession with asymmetry? How do we build a repeatable process for finding heads I win, tails I don't lose much opportunities? The most effective blueprint is a mental model known as the investment pre-mortem. Popularized by the psychologist Gary Klein, a pre-mortem is the hypothetical opposite of a post-mortem. In a post-mortem, after a project fails, the team gets together to figure out what went wrong. In a pre-mortem, you do this exercise before you even begin. You imagine a future where your investment has failed spectacularly, and you work backwards to generate plausible reasons for the failure. This process is a powerful antidote to confirmation bias and overconfidence, and it forces a rigorous examination of the tails scenario. Here's the step-by-step guide to conducting an investment pre-mortem. Step 1. Before you invest a single dollar, gather your investment thesis. You believe Company X is a great investment. You've written down all the reasons why: its great product, its growing market, its strong financials. Now put that thesis aside. Step 2. Convene the pre-mortem. This can be done with a trusted friend, a mentor, or even just by yourself with a pen and paper. The exercise begins with a single, powerful statement. It is 1 year from now. We invested in Company X, and it has been an unmitigated disaster. The stock is down 50%, and our thesis is completely broken. Our task today is not to point fingers, but to write the history of how this failure happened. Step 3. Brainstorm every possible reason for the failure. It is crucial during this phase that you do not critique or defend the original thesis. The goal is to generate a comprehensive list of vulnerabilities. What could have gone wrong? A new competitor with a superior technology could have emerged. The company's key product could have been rendered obsolete by a shift in consumer behavior. The CEO, who you thought was a genius, could have made a disastrous acquisition. A key patent could have expired. The company could have had a hidden accounting fraud. The economy could have entered a deep recession, crushing its sales. You should aim to generate at least 10 to 20 specific, plausible failure scenarios. This is the process of mapping the entire landscape of the tails side of the equation. Step 4. Analyze the list and categorize the risks. Once you have your list, go through each potential cause of failure. For each one, ask 2 questions. First, what is the probability of this event occurring? Is it a remote, black swan possibility, or a significant, foreseeable threat? Second, what is the likely magnitude of the impact if it does occur? Would it be a minor setback or a fatal blow to the company? This step forces you to move from simply identifying risks to actively quantifying them, which is the essence of advanced risk management. Step 5. The final judgment. Now, and only now, do you return to your original head's thesis. You look at the potential upside you envisioned and weigh it against the detailed map of downside risks you have just created. This is the moment of truth for the asymmetric bet. Is the potential reward truly large enough to compensate you for the catalog of risks you have uncovered? If, after this rigorous pessimistic exercise, you find that the downside is contained, manageable, and far outweighed by a massive potential upside, then and only then do you have an investment that passes the Buffett test. The premortem is a systematic process for cultivating a healthy paranoia, forcing you to respect the potential for loss before you become seduced by the prospect of gain. It is the practical tool for executing the tails I don't lose much philosophy. The path of the 99% is a stark and painful contrast to this disciplined approach. While Buffett is meticulously searching for asymmetric payoffs, the average investor is irresistibly drawn to their polar opposite, the lottery ticket. This is the realm of high-risk speculative bets, where the head scenario is a life-changing jackpot, but its probability is infinitesimally small, and the tails scenario is a near-certain total loss. These investments are packaged and sold with compelling stories that appeal directly to our greed and our desire for a shortcut to wealth. The most common form is the penny stock. This is a tiny, struggling company, often in a hot sector like biotech or mining exploration. The story is always tantalizing. They are on the verge of a breakthrough cancer drug, or they've discovered a massive gold deposit. The stock trades for pennies a share, and the promoter's pitch is simple. If this thing works, it won't just double, it will go up 100-fold. You can turn $1,000 into $100,000. The investor, seduced by this narrative of explosive upside, completely ignores the asymmetry. They never conduct a premortem. They never ask about the tails scenario. The reality is that the vast majority of these companies have flimsy balance sheets, unproven products, and a history of burning through cash. The probability of their miracle drug getting approved, or their gold mine being profitable, is not 50% or even 10%. It's often less than 1%. The tails scenario bankruptcy is the overwhelmingly likely outcome. They are buying a bet with a 99% chance of a 100% loss and a 1% chance of a huge gain. This is the mathematical equivalent of lighting money on fire. Another version of this behavior is chasing story stocks at insane valuations. A company with a charismatic CEO and a revolutionary product captures the public's imagination. Its stock price detaches from any underlying business reality and soars into the stratosphere. Investors buying at these levels are making a profoundly asymmetric bet in the wrong direction. The head scenario is that the company grows into its gargantuan valuation, in which case the stock might go up a little more. The tails scenario is that the company stumbles, the growth story falters, and the valuation collapses back to earth, resulting in an 80% or 90% loss. They are risking a catastrophic amount of capital for a meager potential gain. They are picking up pennies in front of a steamroller. At the other end of the spectrum is the illusion of safety, which is just as dangerous. This investor is so paralyzed by loss aversion that they only seek out investments with a near-certain, but tiny, upside. They put their money in low-yield government bonds or certificates of deposit. Here, the asymmetry is also terrible. The heads scenario is that they earn a 2% return. The tails scenario, which they often ignore, is the insidious risk of inflation. If inflation is running at 4%, their safe 2% return is actually a 2% loss in purchasing power each year. They have avoided the volatility of the stock market, but they have guaranteed a slow, certain erosion of their wealth. In all of these cases, the 99% are failing to think like a professional bettor. They are seduced by narratives of jackpots or lulled into a false sense of security, while completely ignoring the fundamental architecture of the bet, the relationship between what they stand to win, what they stand to lose, and the probabilities of each. This failure to grasp the concept of asymmetry is one of the single greatest destroyers of wealth for the average investor. The direct financial connection between the principle of asymmetry and long-term wealth building can be understood through the mathematical concept of expected value. Expected value is a tool used in probability theory to determine the long-run average outcome of a random event. The formula is simple. You take the probability of a gain and multiply it by the magnitude of that gain, and then you subtract the probability of a loss multiplied by the magnitude of that loss. A rational investor should only ever make investments where the expected value is significantly positive. Let's apply this to a real-world scenario. Imagine two investment opportunities. Investment A is a safe, blue-chip utility stock. You do your analysis and conclude there is a 90% probability that it will return 8% over the next year. There is, however, a 10% probability of a recession that could cause the stock to fall by 20%. Let's calculate the expected value. 0.90*8% minus 0.10*20% equals 7.2% to 2.0% equals plus 5.2%. This is a positive expected value. It's a decent but not spectacular bet. Now consider investment B. This is a high-quality but out-of-favor company, similar to American Express during the salad oil scandal. Your deep research suggests that the market is overly pessimistic. You estimate there is a 60% chance that the market will realize its error and the stock will double, a 100% gain. You also believe there is a 40% chance you are wrong, and the company's problems are worse than they appear, in which case the stock could fall by 30%. Let's calculate the expected value for this seemingly riskier investment. 0.60*100%, 0.40*30% equals 60% to 12% equals plus 48%. The difference is breathtaking. Investment B, the asymmetric bet, has an expected value that is more than 9 times higher than investment A. A portfolio constructed of bets like investment B will, over the long run, grow at a dramatically faster rate than a portfolio of bets like investment A. This is the mathematical engine behind Buffett's wealth creation. He is relentlessly scanning the universe of opportunities for situations with massively positive expected value. This concept also connects directly to the legal structure of stock ownership. As a shareholder, your liability is limited. If you invest $10,000 in a company and it goes bankrupt, the most you can possibly lose is your initial $10,000. Your downside is capped. However, your upside is theoretically infinite. The company could grow to be 10, 100, or 1,000 times its original size. Stock ownership is, by its very nature, an asymmetric contract. The fatal mistake most people make is to pay such a high price for a stock that they destroy this natural asymmetry. By overpaying, they create a situation where the downside, a 50 to 80% loss, is massive, while the upside, maybe a 10 to 20% gain, is small. Buffett's discipline of buying with a margin of safety, paying significantly less than a business's intrinsic value, is a mechanism for preserving and amplifying the natural, powerful asymmetry of equity investing. It is how he ensures that the financial mathematics are always tilted heavily in his favor. To consistently execute a strategy of concentrated asymmetric betting requires a character trait that is in critically short supply in the modern world: patience. The financial markets are a symphony of noise, a constant barrage of information, opinion, and stimuli designed to provoke action. Tickers flash, news alerts pop up, and experts on television declare with absolute certainty what you must buy or sell today. This environment preys on a deep-seated human instinct to do something, to react, to be involved. But the third pillar of Buffett's system is the mastery of strategic inactivity. He famously described his approach using a baseball analogy. The stock market is a no-called strike game. You don't have to swing at everything. You can wait for your pitch. In baseball, a batter who lets 3 good pitches go by is out. In investing, there are no called strikes. You can stand at the plate for days, weeks, months, or even years, watching thousands of pitches, investment opportunities, go by. You can wait for that one perfect, slow, fat pitch right down the middle of the plate, and only then do you swing with everything you've got. This patience is not a passive act of laziness. It is an active, strategic weapon. It is the discipline to conserve your two most precious resources, your capital and your mental energy, for the rare moments when a truly extraordinary opportunity presents itself. While the rest of the market is frantically swinging at every pitch, getting tired and making weak contact, the probabilistic bettor is calmly waiting, knowing that the quality of their swings, not the quantity, will determine their long-term success. The most dramatic public demonstration of this strategic patience occurred during the late 1990s, at the height of the dot-com bubble. It was a period of wild, unadulterated euphoria. A new paradigm, the internet, was changing the world, and any company with a .com at the end of its name was soaring to astronomical valuations. Companies with no profits, no revenues, and sometimes no viable business plan were going public and seeing their stock prices double or triple in a single day. The public was intoxicated. Taxi drivers were trading tech stocks. Financial television was a non-stop party. And during this period of unprecedented market mania, Warren Buffett was doing nothing. Berkshire Hathaway's portfolio was filled with old economy stalwarts like Coca-Cola, Gillette, and the Washington Post. He openly admitted that he didn't understand the new internet businesses and their sky-high valuations, so he simply refused to play the game. The result was a period of intense criticism and ridicule. For the first time in his career, Buffett was seen as a relic, a dinosaur who had lost his touch. Barron's, the influential financial magazine, ran a cover story in 1999 with the headline, "What's Wrong, Warren?" The article detailed Berkshire's dramatic underperformance relative to the NASDAQ index and questioned whether his value investing principles were obsolete in the new digital age. For 2 consecutive years, 1998 and 1999, Berkshire Hathaway's stock lagged the S&P 500 significantly. The pressure was immense. His own shareholders were questioning him. The media was mocking him. Every psychological and social force was pushing him to abandon his discipline and join the party. But Buffett did not swing. He saw the pitches flying by, the Pets.coms, the Webvans, the GeoCities, and he recognized them for what they were, fastballs aimed at his head. They were speculative gambles, not the high-probability asymmetric opportunities he looked for. They were priced for perfection, with no margin of safety. The heads scenario was that you might make a bit more money in an already frenzied market. The tails scenario was a catastrophic collapse, so he waited. In his 1999 letter to shareholders, he calmly explained his inactivity. He wrote, "The line separating investment and speculation, which is never bright and clear, becomes blurred still further when most market participants have recently enjoyed triumphs. Nothing sedates rationality like large doses of effortless money." He was admitting that he couldn't find any pitches to his liking, and he was perfectly content to keep the bat on his shoulder. Then, in March of 2000, the bubble burst. The NASDAQ index, which had peaked above 5,000, began a brutal and relentless collapse. Over the next 2 years it would fall by nearly 80%, wiping out trillions of dollars in paper wealth. The high-flying dot-com darlings went bankrupt in droves. The effortless money vanished, and rationality returned with a vengeance. And what happened to Berkshire Hathaway? As the speculative frenzy collapsed, investors fled back to the safety of real, profitable businesses. Berkshire's stock, which had been a laggard, began to soar. Buffett, with his massive war chest of cash that he had patiently accumulated, was now in the perfect position to go on a buying spree, picking up wonderful businesses at bargain prices from the wreckage. His patience had not only protected his shareholders from the devastating crash, but it also armed him with the capital to take advantage of the subsequent fear. It was a masterclass in strategic inactivity, a powerful demonstration that sometimes the most profitable action an investor can take is no action at all. This discipline is a core requirement for any entrepreneur or CEO responsible for capital allocation. The impulse to act, to constantly be doing something, is one of the most powerful and destructive forces in human nature, especially when it comes to investing. This is known as the action bias. Our brains evolved in an environment where quick action was often essential for survival. When you heard a rustle in the grass, it was better to run first and ask questions later. The caveman who sat around patiently analyzing the situation was more likely to become lunch. This ancient wiring persists in our modern skulls. We have an innate belief that activity is correlated with progress. We feel more productive when we are busy, and we feel anxious and unproductive when we are idle. In many areas of life, this bias serves us well. But in the world of investing and long-term wealth building, it is a catastrophic flaw. The financial industry is a giant machine built to exploit the action bias. Your brokerage account is designed with flashing lights, real-time quotes, and buy and sell buttons that are just begging to be clicked. Financial news networks create a sense of urgency and immediacy, with breaking news alerts and countdown clocks that imply you must act now or miss out. The constant stream of information creates an illusion that you need to react to every data point, every earnings report, every geopolitical event. This constant stimulation triggers our action bias, leading to a behavior known as overtrading. Investors who overtrade are constantly buying and selling, churning their portfolios in response to the noise. They are swinging at every pitch. The consequences of this behavior are devastatingly corrosive to returns. First, there are transaction costs. Every time you buy or sell, you may be paying a commission. More importantly, you are crossing the bid-ask spread, which is a hidden but very real cost. These small frictions add up over time, acting as a constant drag on your performance. Second, and far more significant, are taxes. If you hold an investment for more than a year, any gain is typically taxed at a lower long-term capital gains rate. If you sell within a year, the gain is taxed at your ordinary income tax rate, which is often much higher. Overtrading ensures that a larger portion of your gains, if you have any, are given to the government instead of being left to compound in your account. Buffett's strategy of extreme patience and long holding periods is, in part, a brilliant tax minimization strategy. By rarely selling, he allows his investments to compound for decades in a tax-deferred manner, a massive and often overlooked advantage. Buffett's ability to sit still, to resist the siren song of action, is a direct countermeasure to this deep-seated psychological flaw. He has trained himself to equate activity not with progress, but with potential error. He understands that every decision to act carries the risk of being wrong, while the decision to wait and do nothing, when no great opportunity is present, is almost always the correct one. He has inverted the action bias, turning patience from a passive state into his most potent offensive weapon. To cultivate this superpower of patience, we need a system, a set of rules that forces us to be inactive until a truly exceptional opportunity presents itself. This system is the investment kill box checklist. The concept comes from military strategy, where a kill box is a three-dimensional area of a battlefield where all targets are pre-authorized for immediate engagement. In our context, an investment idea must pass through a rigorous multi-gate checklist before it can enter the kill box, where we are authorized to deploy capital. This creates a powerful filter that rejects 99% of ideas, forcing us to wait for the true fat pitch. Here is a blueprint for building your own investment kill box checklist. This is not a rigid formula, but a framework that you must adapt to your own philosophy. Step 1. The business must be simple and understandable. This is the first gate. Can you, in a few simple sentences, explain how this business makes money? If the answer involves complex financial engineering, arcane technology you don't understand, or a convoluted business model, the idea is immediately rejected. It does not pass Gate 1. You are not authorized to proceed. This rule alone would have saved investors from the dot-com bust and the 2008 financial crisis. Step 2. The business must have a durable competitive advantage, or a moat. This is the second gate. What protects this business from competition? Is it a powerful brand like Coca-Cola? Is it a low-cost process like Geico? Is it a network effect like American Express? Is it high switching costs? You must be able to clearly identify and articulate the company's moat. If you cannot, or if the moat appears to be shrinking, the idea is rejected. It does not pass Gate 2. Step 3. The business must have able and trustworthy management. This is the third gate. Have you studied the CEO and the senior leadership? Do they have a long track record of integrity and intelligent capital allocation? Do they communicate candidly with shareholders in their annual reports? Do they run the business for the long-term benefit of the owners or for their own short-term enrichment? If you have any doubts about the character or competence of the management team, the idea is immediately rejected. It does not pass Gate 3. Step 4. The business must be available at a significant discount to its intrinsic value. This is the final and most important gate. Even the best business in the world is a terrible investment if you overpay for it. You must have a conservative estimate of what the business is worth, and the current market price must offer a substantial margin of safety. A 25% discount might be a minimum, but a 40% or 50% discount is what you should be waiting for. If the price is merely fair or only slightly undervalued, the idea is rejected. It fails to pass the final gate. This 4-gate kill box is a powerful system for enforcing patience. An investment idea must get a yes on all 4 criteria, not 3 out of 4, all 4. The universe of companies that can pass through this rigorous filter at any given time is incredibly small, and that is the entire point. The checklist forces you to say no thousands of times, so that when you finally get to say yes, it is with the highest possible degree of conviction. It transforms you from a frantic speculator, swinging at every pitch, into a patient predator, waiting calmly for that one perfect opportunity to walk into your crosshairs. This is the operational discipline behind strategic inactivity. The antithesis to this patient, predatory mindset is the hyperactive world of the day trader. This is the ultimate expression of the action bias, a frenetic approach to the market that is almost perfectly designed to destroy wealth. The day trader's worldview is that the market is a video game. They sit in front of multiple screens displaying flashing charts, news feeds, and order books. They believe that by reacting faster and more frequently than others, they can scalp tiny profits from the market's moment-to-moment fluctuations. Their time horizon is not years or even days. It is minutes or seconds. They are not investing in businesses. They are renting ticker symbols. This entire methodology is built on a series of fatal flaws. First, it is a negative-sum game. After accounting for commissions, spreads, and taxes, the pool of money available to be won by traders is constantly shrinking. For every winner, there must be a loser, and both are paying the house. The only guaranteed winners are the brokers and the exchanges that facilitate the churning. Second, it is a fool's errand to believe you have an edge in this game. The day trader is competing against high-frequency trading firms with billion-dollar algorithms, direct data feeds, and teams of PhDs in physics and computer science. Believing you can outreact these institutional players with your consumer-grade internet connection and charting software is the height of hubris. But the most insidious damage is psychological. The day trading mindset trains the brain to be reactive, not reflective. It elevates market noise to the level of signal. Every news headline, every twitch in a stock's price becomes a reason to act. This constant state of agitation makes deep, long-term thinking impossible. You cannot be analyzing the 10-year competitive advantages of a business while simultaneously trying to scalp a 10-cent move in its stock price. It is a form of self-inflicted attention deficit disorder. The day trader is swinging at every single pitch, including the ones in the dirt. They are constantly making low-probability bets, racking up transaction costs, and getting whipsawed by market volatility. The end result, for the overwhelming majority, is a slow and painful bleeding out of their capital. They mistake activity for achievement and motion for progress. They are the polar opposite of Buffett, who understands that true wealth is built not in the frenzy of trading, but in the quiet solitude of patient waiting. He is playing chess while they are playing whack-a-mole. The direct financial connection between patience and portfolio returns is one of the most powerful and underrated forces in finance. It can be summarized in 2 words: compounding and taxes. Let's quantify the devastating impact of the opposite approach: hyperactivity. Consider 2 investors. Investor A, the patient predator, and Investor B, the hyperactive trader. Both start with $100,000 and, through skill or luck, are able to generate a 20% pre-tax return each year. Investor A achieves this by buying a handful of great businesses and holding them for many years. Their portfolio turnover is very low. Investor B achieves the same 20% pre-tax return through rapid trading, holding positions for less than a year. Let's look at the impact of taxes. Investor A's gains are long-term capital gains, taxed at, let's say, a 15% rate. So their after-tax return is 20%, 1 to 0.15, which equals 17%. Investor B's gains are short-term, taxed at their ordinary income rate. Let's assume a federal and state blended rate of 40%. Their after-tax return is 20%, 1 to 0.40, which equals 12%. Now, let's compound their initial $100,000 over 30 years. Investor A's capital, compounding at 17% per year, grows to an astonishing $11,558,000. Investor B's capital, compounding at 12% per year, grows to $2,995,000. The difference is over $8.5 million. It is a life-altering gap in wealth, created by a single variable, the holding period. And this calculation doesn't even include the corrosive effect of transaction costs from overtrading, which would further widen the gap. On a financial statement, patience manifests as a dramatically lower tax liability on the income statement and a much higher compounded growth rate of equity on the balance sheet. The strategy of strategic inactivity is not just a philosophical preference, it is a mathematical imperative for anyone serious about wealth building. By simply doing less, by letting your well-chosen businesses compound without the constant interruption of taxes and trading costs, you unlock the most powerful force in the universe, as Einstein supposedly called it, compound interest. The patient investor allows this force to work for them, while the hyperactive trader is constantly fighting against it. Now we arrive at the fourth pillar, a concept that underpins and enables all the others. Buffett's ability to make large, concentrated, asymmetric bets with extreme patience is not born from reckless courage or a gambler's intuition. It is grounded in a deep and humble understanding of the limits of his own knowledge. This is the principle of the circle of competence. The concept is deceptively simple. Each of us, through our experiences, studies, and careers, has developed a deep understanding of certain subjects. This area of deep knowledge is our circle of competence. Outside of this circle are subjects we may have a passing familiarity with, and beyond that lies a vast universe of topics about which we are profoundly ignorant. The rule of the circle of competence, as it applies to investing, is to draw a clear line around the area you truly understand and to never, ever make an investment outside of it. This isn't about how big your circle is. A big circle is not necessarily better than a small one. What is critically important is that you know precisely where the perimeter of your circle lies. As Buffett says, you don't have to be an expert on every company. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. This pillar is the probability engine of the entire system. It is only by operating within a well-defined area of expertise that an investor can realistically hope to calculate the true probabilities of success and failure, and to accurately assess the potential upside and downside of a bet. The perfect anecdote to illustrate the power of this principle is Buffett's 1973 investment in the Washington Post Company. This was not a flashy tech company or a complex financial firm. It was a newspaper, a business that Buffett understood intimately. His circle of competence in the media industry was deep and well-earned. He had been a paperboy as a child. He had owned and operated a small newspaper in Omaha. He was an avid reader of dozens of publications and had studied the economics of the industry for years. He knew that in the pre-internet era, a dominant city newspaper was one of the greatest businesses imaginable. It was a local monopoly. If a resident of Washington, D.C. wanted to find movie times, read classified ads for jobs or apartments, or get local news, they had to buy the Washington Post. If a department store wanted to advertise a sale to the entire city, they had no choice but to place an ad in the Post. This created an incredibly powerful and durable moat. In 1973, the stock market was in a deep funk. The Nifty 50 bubble had popped, and investor sentiment was abysmal. The Washington Post Company, despite its fantastic business economics, saw its stock price get hammered along with the rest of the market. The entire company had a market capitalization of around $80 million. Buffett, operating deep within his circle of competence, was able to analyze the company not as a flickering stock quote, but as a business. He asked himself, what would a private buyer, someone who understood the newspaper business, be willing to pay for the entire Washington Post Company? He conservatively estimated that its properties, the newspaper itself, Newsweek magazine, and several television stations, were worth at least $400 million and probably more. Yet, the stock market was offering him the chance to buy a piece of it for a collective valuation of just $80 million. He was being offered the chance to buy a dollar bill for 20 cents. This was an opportunity created by a combination of a temporary market panic and Buffett's specialized knowledge. An investor without his deep understanding of the media business would not have been able to see the value with such clarity. They might have seen a declining industry, worried about the rise of television news, and gotten scared by the falling stock price. They would have been operating outside their circle of competence, and the situation would have seemed ambiguous and risky. But for Buffett, there was no ambiguity. Inside his circle, the probabilities were crystal clear. The tails scenario was that the business would merely continue to be a fantastic, cash-gushing monopoly, and he would make a handsome return. The heads scenario was that the market would eventually wake up to its absurdity and reprice the company to its true value, resulting in a massive gain. The risk of permanent loss was, in his mind, zero. He invested over $10 million, buying up nearly 10% of the company, and it became one of the cornerstones of Berkshire Hathaway's portfolio. That initial investment would grow to be worth over $1 billion, a 100-fold return. This was not luck. It was the inevitable result of combining deep, specialized knowledge with market volatility. The circle of competence was the lens that allowed him to see the incredible odds that were being offered. The psychological principle that the circle of competence is designed to combat is one of an investor's most dangerous and self-destructive tendencies: the overconfidence bias, often coupled with its close relative, the Dunning-Kruger effect. Overconfidence bias is the well-documented human tendency to have excessive faith in our own judgments and abilities. We systematically overestimate how much we know and underestimate the role of chance in our successes. In investing, this manifests as a belief that we can successfully predict the outcomes of businesses and industries about which we have only a superficial understanding. We read a few articles about artificial intelligence, and we suddenly believe we are qualified to pick the winning AI stocks for the next decade. We hear a compelling story about a new biotechnology, and we ignore the years of scientific training required to truly assess its prospects. This arrogance is a recipe for disaster. The Dunning-Kruger effect, identified by psychologists David Dunning and Justin Kruger, adds a dangerous twist. Their research showed that people with low ability at a task tend to dramatically overestimate their ability. In other words, the most incompetent people are often the most confident in their own expertise because they lack the self-awareness to recognize their own shortcomings. An amateur investor who has just had a bit of luck in the market is particularly susceptible to this. They might mistake a bull market for their own genius. Their early success creates a dangerous feedback loop of overconfidence, leading them to take bigger and bigger risks in areas they don't understand. They have wandered far outside their circle of competence, but they are blissfully unaware of it because they don't even know enough to know what they don't know. The circle of competence is a deliberate, conscious system for imposing intellectual humility. It is a mental discipline that forces you to start with a default assumption of ignorance. Instead of asking, "What do I know?" you start by asking, "What do I not know?" By clearly defining the boundaries of your expertise, you are creating a defense mechanism against the lethal combination of overconfidence and the Dunning-Kruger effect. It prevents you from being seduced by compelling narratives in fields you cannot possibly hope to master without years of dedicated study. Buffett's famous refusal to invest in tech stocks during the dot-com bubble was not a judgment on the technology itself. It was a humble and honest admission that it was outside his circle of competence. He could not, with any degree of confidence, predict which of the hundreds of competing companies would emerge as long-term winners. Therefore, he couldn't calculate the probabilities, and if you can't calculate the probabilities, you can't make a rational bet. Sticking to your circle is the ultimate act of intellectual honesty, a critical component of any successful, long-term investment strategy. So how can you methodically and honestly define your own circle of competence? The blueprint for this is a practical exercise I call the 3 circles. This mental model will help you map your own knowledge landscape and create clear rules of engagement for your investment decisions. Take out a piece of paper and draw 3 concentric circles, one inside the other. The innermost circle, the bullseye, you will label Circle 1, Deep Expertise. This circle represents the very small number of topics, industries, or businesses that you understand with profound depth. This expertise is usually derived from your profession, a lifelong passion, or years of intense, dedicated study. If you are a software engineer, this circle might contain enterprise software companies. If you are a doctor, it might be healthcare or medical device companies. If you are a retail manager, it could be consumer brands. To qualify for Circle 1, you should feel that you have a genuine informational or analytical edge over the average Wall Street analyst covering that industry. You understand the nuances, the competitive dynamics, and the key variables for success better than 99% of other investors. This circle will likely be very, very small. For most people, it will contain only 1 or 2 industries, at most. The strict rule of this model is that Circle 1 is the only $2 area where you are permitted to make individual stock picks. The middle circle you will label Circle 2, Working Knowledge. This area represents subjects you know something about, but where you are not a true expert. You might have a good general understanding of the banking industry, or you might follow consumer technology closely because you're interested in it. You can hold an intelligent conversation about these topics, but you don't have a deep, proprietary insight. The rule for Circle 2 is simple. You are not allowed to buy individual stocks here. The risk of overconfidence is too high. However, this is the perfect area for investing via low-cost index funds or ETFs. If you believe in the long-term prospects of the technology sector but don't feel qualified to pick the individual winners and losers, buying an ETF that tracks the NASDAQ 100 is a perfectly rational way to participate. The outermost and largest area you will label Circle 3, Total Ignorance. This represents the vast majority of the economic world. This is complex biotechnology, shipping logistics, cyclical mining operations, speculative cryptocurrencies, and thousands of other industries about which you know little or nothing. The rule for Circle 3 is absolute and non-negotiable. This is a strict no-fly zone. You do not invest here, ever, under any circumstances. You don't listen to tips. You don't get tempted by stories. You don't succumb to FOMO. You humbly and honestly admit your ignorance, and you stay away. The 3 circles exercise is a powerful tool for self-assessment. It forces you to confront the limits of your knowledge and creates a simple, rules-based system for making decisions. It ensures that when you do make a concentrated, high-conviction bet, you are doing it on your home turf, where the odds of success are tilted dramatically in your favor. This is the foundation of a true CEO mindset for personal capital allocation. The path of the 99% is a tragic rejection of this humble approach. Instead of honestly assessing their own knowledge, they engage in a behavior we can call guru following. This is the practice of outsourcing your critical thinking to someone else, a charismatic TV personality, a popular blogger, a newsletter writer, or a random poster on a social media forum. The guru follower operates under the illusion that they can achieve superior returns without doing the hard work of independent research. They see someone who seems confident and successful, and they simply try to copy their trades. This strategy is doomed to fail for several fundamental reasons. First, you are always acting on delayed, incomplete information. By the time a guru publicly discloses a new purchase, the price may have already run up. You have no idea what their entry price was. More importantly, you will have absolutely no idea when they decide to sell. They are not going to call you when their thesis changes or when they believe the stock has become overvalued. You are flying blind, a passenger in a car being driven by someone you've never met. Second, and more fundamentally, by following a guru, you have no true conviction of your own. You haven't done the deep research. You don't understand the business, its moat, or its valuation. You are renting the guru's conviction. This lack of own conviction becomes a catastrophic liability the moment the investment runs into trouble. If the stock you bought on a tip suddenly drops 20%, what do? You have no basis for making a decision. Is this a temporary dip and a great buying opportunity? Or is the original thesis now broken? You don't know. Panic sets in. The most common reaction is to sell at a loss, just to stop the psychological pain. Conversely, if the stock goes up, you have no idea when to take profits. You are completely adrift, reliant on the next pronouncement from your chosen guru. This behavior is driven by a desire for a shortcut, a belief that you can get the rewards of diligent, expert investing without paying the price in time and effort. It is the intellectual equivalent of trying to get in shape by watching someone else exercise. The guru follower is willfully operating in their circle 3, the zone of total ignorance, but they have convinced themselves it's safe because they are holding someone else's hand. This is a complete abdication of personal responsibility and a guaranteed path to poor results. The circle of competence demands that you be the expert, that you build your own conviction, and that you own your decisions, both the successes and the failures. The financial connection between the circle of competence and your portfolio is direct and powerful. It is the primary defense against catastrophic error. In the language of portfolio management, this is about reducing the frequency of unforced errors. An unforced error in tennis is when a player makes a mistake that is not caused by the opponent's skill, like hitting a simple forehand into the net. In investing, an unforced error is taking a large loss on an investment that you never should have made in the first place because it was in a business you didn't understand. These are the self-inflicted wounds that can cripple a portfolio for years. Think of your investment capital as your army. A catastrophic loss, a zero or a near zero on a significant position, is like losing an entire division of that army. It is a devastating blow from which it is very difficult to recover. You cannot compound from zero. The primary financial benefit of staying strictly within your circle of competence is that it drastically lowers the probability of these devastating capital-destroying mistakes. When you are operating on your home turf, you are far less likely to be surprised by a competitive threat or a change in industry dynamics. You have a much better feel for the range of possible outcomes. This doesn't eliminate risk, but it transforms it from an unknowable fog into a manageable set of probabilities. On a balance sheet, the circle of competence is the guardian of your asset base. It is the principle of capital preservation in its most potent form. By avoiding the big mistakes, by keeping your army intact, you guarantee that you will be able to stay in the game long enough for the power of compounding on your successful high-conviction bets to work its magic. We have now arrived at the final pillar, the capstone that integrates all the previous principles into a single, decisive action. We have established the importance of concentration over diversification, the search for asymmetric payoffs, the necessity of patience, and the discipline of the circle of competence. But all of this leads to one final critical question. Once you have found that rare, perfect pitch, a wonderful, understandable business with a durable moat and honest management, which is selling at a massive discount to its intrinsic value, how much should you bet? This is the question of position sizing, and it is arguably the most important and least understood element of advanced investing. The answer lies in a framework that marries your level of conviction with the mathematics of probabilistic betting. This is the practical application of the famous and often misunderstood Kelly criterion. While Buffett doesn't use a formal mathematical formula, His intuitive approach to capital allocation is a masterclass in Kelly's underlying logic. The principle is this: the size of your bet should be directly proportional to the perceived size of your edge. You don't treat all good ideas equally. You give the most capital to your absolute best ideas, the ones where the probability of success and the asymmetric payout are the highest. This is how you maximize the long-term geometric growth rate of your portfolio, the ultimate goal of any serious investor. The quintessential example of Buffett's intuitive position sizing in action was his monumental investment in the Coca-Cola Company in the late 1980s. Following the stock market crash of October 1987, investor sentiment was still fragile. Coca-Cola, one of the most powerful and recognizable brands on the planet, saw its stock price languish along with the rest of the market. Buffett had been a lifelong consumer of Coke, drinking at least 5 cans a day. He had studied the company for years. It was squarely in his circle of competence. He understood its simple but brilliant business model: sell a concentrated syrup to a global network of bottlers who then do the heavy lifting of mixing, bottling, and distributing the final product. He saw its unassailable moat, a brand name that was synonymous with happiness and refreshment in virtually every country on Earth. This brand gave it immense pricing power and a permanent share of the consumer's mind. He analyzed the numbers and saw a business with staggering economics. It had high returns on capital, required very little incremental investment to grow, and was gushing cash. He also saw its immense global growth potential. While Coke was dominant in the United States, its per capita consumption in many large developing countries was a tiny fraction of American levels. The runway for growth was enormous. In 1988, he saw all of this, a nearly perfect business, being offered in the stock market at a price he considered ridiculously cheap. The market was valuing the entire company at around $14 billion, a valuation that failed to appreciate its global dominance and future growth prospects. For Buffett, this was not just a good pitch. It was the fattest, slowest pitch he had ever seen in his life. The probability of success was extremely high, and the potential upside, as the company continued its global expansion, was massive. The tails scenario was virtually non-existent. Coca-Cola was not going out of business. So how did he size the bet? A typical fund manager might have made it a 5% position, a significant but still prudent allocation. Buffett, applying his intuitive Kelly logic, did something far more radical. Between 1988 and 1989, Berkshire Hathaway invested over $1 billion to acquire a stake in Coca-Cola. At the time, this represented more than a quarter of Berkshire's entire portfolio. It was an incredibly concentrated, high-conviction bet. He was allocating capital in direct proportion to his perceived edge. His edge here was not just that Coke was a good company, but that it was a once-in-a-generation company being offered at a once-in-a-generation price. The opportunity was exceptional, and therefore the position size had to be exceptional. The result was spectacular. The investment in Coca-Cola became one of the most successful in financial history. Within 10 years, Berkshire's $1 billion stake was worth over $13 billion. It was a testament to the power of sizing your bets correctly. Finding the great idea was only half the battle. The other, equally important half, was having the courage and the discipline to bet big enough to make it matter. Why do most investors fail so miserably at position sizing? The answer lies in a combination of psychological biases that prevent a rational allocation of capital. The primary culprit is what we can call the equality heuristic, or 1N heuristic. When faced with a set of N choices, our brain often defaults to a simple shortcut: allocate resources equally among them. We see this in everyday life. If you give someone a plate of 4 different appetizers, they are likely to try one of each. In investing, this manifests as the tendency to invest the same amount of money, say $5,000, in every stock idea we have. This heuristic feels fair and balanced, but it is financially illogical. It implicitly assumes that every one of your investment ideas has the exact same probability of success and the exact same potential return profile. This is, of course, never true. You will always have more conviction in some ideas than in others. Some bets will have a 10x potential upside, while others may only have a 2x potential. Allocating capital equally across these vastly different opportunities is a profound strategic error. This is often compounded by the law of small numbers, another cognitive bias identified by Kahneman and Tversky. This is our tendency to draw broad, confident conclusions from insufficient data. An investor might have a small, speculative biotech stock that doubles in a month. Based on this tiny sample size of one successful bet, they develop a false sense of confidence in their ability to pick such stocks. This can lead them to make another, much larger bet on a similar company, completely miscalibrating their position size based on a lucky outcome rather than a true, repeatable edge. The Kelly criterion, and Buffett's intuitive application of it, is a direct antidote to these biases. It forces a disciplined, analytical connection between your assessment of an opportunity's merit and the amount of capital you risk. It rejects the lazy equality heuristic and demands that you make tough, differentiated decisions. It requires you to honestly assess your own conviction level. It's easy to say you like 10 different stocks. It is much harder to be forced to decide which one of them deserves 25% of your net worth. This forced ranking imposes a level of intellectual rigor that is absent from most investors' processes. It is the final, crucial step that translates analysis and conviction into a portfolio structure designed for maximum long-term growth. To bring this powerful concept into your own investment process, we can create a simplified, practical mental model, the Buffett-Kelly scorecard. This blueprint allows you to approximate the logic of the Kelly criterion without needing a degree in mathematics. It's a qualitative tool for translating your research into a concrete position size. The scorecard is based on rating every potential investment on two, and only two, critical axes. Axis 1 is conviction and probability. This is a score from 1 to 10 that measures your degree of certainty in the investment thesis. It answers the question, how sure am I that I am right? A score of 1 means it's a wild, speculative guess. A score of 10 means it's as close to a sure thing as you can find in the investment world. A Washington Post at 20 cents on the dollar level of certainty. To get a high score on this axis, the company must be deep inside your circle of competence, Pillar 4, and it must have passed every gate of your investment killbox checklist, Pillar 3. Your conviction must be based on deep, independent research, not a rented opinion. Axis 2 is asymmetry and payout. This is also a score from 1 to 10. It measures the structural quality of the bet itself. It answers the question, how much do I win if I'm right? Versus how much do I lose if I'm wrong? A score of 1 represents a terrible asymmetric profile, small upside and huge downside, a lottery ticket stock. A score of 10 represents the perfect heads I win, tails I don't lose much setup, a C's candies. To get a high score here, you must have done a thorough pre-mortem, Pillar 2, and be satisfied that the downside is protected, while the upside is multiples of the potential loss. Now you combine the scores, you can simply add them together to get a total score out of 20. This final score then translates into a recommended position size. For example, you might create a simple tier system. A total score of 18 to 20. This is an exceptional once-a-decade opportunity. Recommended position size, 15 to 25% of your portfolio. This is your Coca-Cola bet. A total score of 15 to 17. This is a very high-quality, high-conviction idea. Recommended position size, 10 to 15% of your portfolio. A total score of 12 to 14. This is a good idea that meets your criteria. Recommended position size, 5 to 10% of your portfolio. A total score below 12. The idea is rejected. The edge is not large enough to justify committing capital. You wait for a better pitch. This scorecard is a powerful decision-making tool. It forces you to be explicit about the two key variables that drive long-term returns. It provides a logical and consistent framework for position sizing, preventing you from underbetting your best ideas and overbetting your speculative hunches. It is the practical bridge between your research and the final, crucial act of capital allocation, the essence of a true CEO mindset. The antithesis of this disciplined, conviction-weighted approach is the equal-sizing fallacy, the default behavior of the 99%. As we touched on before, this is the investor who allocates the same amount of capital to every idea. They might decide that $5,000 is their standard investment size. So when they find a stable blue-chip company they believe is 20% undervalued, they invest $5,000. Then, when their brother-in-law gives them a tip on a speculative cannabis stock, they also invest $5,000. They have treated two vastly different opportunities. One, a high-probability, modest-return bet. The other, a low-probability, high-risk gamble, as if they were identical. This is a catastrophic failure of capital allocation. By giving the same weight to a speculative hunch as to a deeply researched, high-conviction idea, they are dramatically diluting the impact of their own best thinking. Their portfolio becomes a random assortment of ideas, with its performance driven more by luck than by skill. Even if they are brilliant at identifying great businesses, this flawed position sizing will condemn them to mediocre results. The financial architecture of their portfolio is fundamentally broken. It's like a brilliant general who has a powerful tank division and a small infantry scout unit, but in the decisive battle he assigns them both to equally important tasks on the front line. It's a nonsensical waste of his most powerful asset. This behavior is often rooted in a fear of commitment. Making a large, concentrated bet is psychologically taxing. It forces you to be accountable. If a 25% position goes against you, the pain is real and unavoidable. Spreading your money equally across many small positions is a way to avoid this psychological burden. It's a form of emotional diversification. The investor is protecting their ego, not their capital. They are prioritizing feeling comfortable over getting rich. Buffett's approach requires the emotional fortitude to do the opposite, to embrace the discomfort of concentration, knowing that it is the only rational way to translate a true informational or analytical edge into extraordinary financial returns. The equal-sizing fallacy is the final and most tragic mistake that separates the amateur from the professional, a self-imposed ceiling on an investor's potential for wealth building. The direct financial connection of proper position sizing is the most profound in all of investing. It is about maximizing the geometric mean return of your portfolio. This sounds complicated, but the concept is simple. The arithmetic mean is the simple average. If you have a 50% gain one year and a 50% loss the next year, your arithmetic average return is 0%. But what actually happened to your money? If you started with $100, it grew to $150, and then fell by 50% to $75. You've actually lost 25% of your capital. Your geometric mean return, which reflects the actual compounded result, is negative. The key to long-term wealth is to maximize the compounded or geometric growth rate. This is where the Kelly criterion's logic is so powerful. A series of large losses is devastating to your geometric return because of what's known as, quote, volatility drag. The more your portfolio fluctuates, the more your long-term compounded return is dragged down below your average annual return. The Kelly formula is mathematically designed to find the optimal bet size that maximizes this long-term geometric growth rate. Betting too small means you leave money on the table and your growth is suboptimal. Betting too big, however, is even more dangerous. If you bet too aggressively, a string of bad luck can wipe you out, even if you have a positive edge on each bet. This is called the risk of ruin. Proper conviction-weighted position sizing finds the sweet spot. It allows you to be aggressive when your edge is enormous, pushing your geometric growth rate higher. Simultaneously, it protects you from the risk of ruin by ensuring that no single bet, no matter how high your conviction, is so large that it can permanently cripple your portfolio if it goes wrong. Buffett's investment in Coca-Cola is a perfect example. A 25% position is extremely aggressive, but it's not a 100% position. He was maximizing his edge without exposing Berkshire to an existential threat. On a balance sheet, proper position sizing is the engine of equity growth. It is the active, intelligent force that takes the raw materials of good investment ideas and combines them in the optimal proportions to forge the fastest possible rate of compounding over the long term. It is the final and most crucial skill of the master capital allocator. You have just spent this time rewiring the very foundation of your financial mind. You have moved past the amateur's question of, is this stock going to go up? And you have installed a professional's operating system, one built on a single powerful framework: probabilistic betting. You now understand that building true, lasting wealth is not about being right all the time, it's about the architecture of your bets. It's about concentrating your capital on your best ideas, insisting on asymmetric payoffs where the upside dwarfs the downside, having the immense patience to wait for those rare opportunities, and having the humility to only play in the game you know you can win. You have acquired the mental toolset to stop playing the market's game and start forcing the market to play yours on your terms, where the odds are stacked in your favor. This is a profound and permanent upgrade to your decision-making abilities. But mastering this betting system, understanding precisely how much capital to allocate to an opportunity, is only one half of the equation. It is the powerful cannon, ready to be fired. But a cannon is useless if you don't know where to aim it. The system you've just learned tells you how to bet, but it doesn't tell you which to bet on. Warren Buffett's complete system is a network of interconnected mental models. The probabilistic betting framework is one crucial piece, but it works in tandem with another, equally powerful model: his system for identifying the targets themselves. It's his method for scanning the entire economic landscape and identifying those few untouchable fortress businesses that are worthy of a massive, concentrated bet. What you have learned today is the capital allocation engine. But that engine needs fuel. The video that is now on your screen is the next piece of the map. It is the targeting system that feeds the engine. It decodes the other half of the master plan, the specific, non-negotiable business characteristics Buffett demands before he will even consider deploying a single dollar of capital. One model without the other is incomplete. It's having a world-class army with no intelligence on where to deploy it. The journey of an investor is a journey of assembling a complete mental arsenal. Amateurs look for tips and shortcuts. Professionals build a complete, interlocking system of thought. The choice of whether to leave your arsenal half-finished or to acquire the second critical component of the machine is right in front of you. The path to becoming a true capital allocator continues with your next decision.